Hey, it's Tom here and welcome back to the channel. Now, this is going to be one of our monthly Q&A videos. I put up a community post here on YouTube a couple of days ago and collected all of your questions. So I'm just kind of going to film for 20 or 30 minutes and kind of see how many I can get through. So if you do want to ask a question in a future video, definitely just keep an eye on my community sort of page. So you can turn notifications on for that, and then anytime I put up a new community post asking for questions for these types of videos, that should pop up and you'll be able to get in there quickly and ask a question. But with all that said, let's get straight into the video and I hope you enjoy. Okay, so first question here is from Andrew Brown. Shout out to Andrew. He was part of the Margin of Safety Movember team for November just gone. So go and check out Andrew on YouTube if you're not following him already. So question from Andrew: if a company is worth the sum of its future cash flows discounted back at an appropriate rate, then why do most people try to value Berkshire Hathaway on a book value or on book value rather than cash flow? Yeah, good question. I think for this one, it's really a combination of it's what Buffett does. It's kind of he's always used book value as a proxy for intrinsic value for Berkshire. It's a combination of that and just sheer simplicity. I mean, Berkshire has obviously a big stock portfolio. They have huge insurance businesses, and then they have all the other subsidiaries that are probably more well suited to being valued on like a discounted cash flow type basis, like the Seas Candies and the energy business and so on. But we probably don't get enough detail, and I don't know that you'd even ever want to work through the like 70 or 80 subsidiaries or whatever there is and try to do like a sum of the parts type valuation. So I think it's really just a combination of that's kind of how Buffett, sort of a Buffett proxy of doing it, and also just sheer simplicity in using sort of a book value multiple. It is probably worth noting that, obviously Berkshire has large insurance businesses as well, and they're typically valued on a book value basis. I guess it's a little bit like a real estate company in some ways, where the value of the business or the cash flows that the business can produce is very dependent on the assets that that business obviously has if you're a real estate company. And there's similar kind of things in insurance and in banking as well, where people are typically looking at the book value and what sort of returns they can generate on that equity as well. They're kind of the two things that like bank analysts and people like that sort of look at. So hopefully that answers your question. I often defer to Chris Bloomstrand, who runs Central Augustus. He writes like 80 or 100 page letters every year. They're kind of like crazy long shareholder letters, and Berkshire has been his biggest holding for a very long period of time, and he does I think 3 or 4 different kind of approaches to calculating intrinsic value for Berkshire and tracks kind of how he thinks intrinsic value changes year to year. So if you want some much more nuanced thoughts than I'm probably able to give you, I think that's a nice place to go as well. But appreciate the question. Next one is from Money with Marcus. If Baba was to delist, how do you plan on going about converting those shares to Hong Kong shares? Yeah, so in theory at least, the US listed stock Baba should be sort of fully fungible, I think the term is, or easily able to be converted across to the Hong Kong listed shares. But it seems to be very dependent on your broker. So my Alibaba shares, for example, are held with Hatch here in New Zealand. They use another broker in the US called Drive Wealth to actually do their brokerage. They're sort of just the user interface and customer relation type part of the brokerage equation. So I'll maybe leave a link down in the description if anyone else happens to be a Hatch customer. They've actually put an article on their website on this exact topic. Not with Alibaba specifically, but they said with Chinese stocks, if they were to get delisted, what kind of happens. So that will cover any sort of Kiwi investors that hold Alibaba. I know Brad Cowner, Stock Compounder, did a video just in the last couple of days on how he can go about converting with his broker. I think he uses Fidelity, and there are a few people in the comment section that use other kind of US brokers. So I would contact your broker to get more info on that, because it probably is going to be quite broker specific. But in theory, at least, you should be able to convert from the US listed Baba to the Hong Kong listed Baba if your brokerage offers those shares. So hopefully that's helpful. Next question is from Jonathan. What quantitative factors or qualitative factors do you look at when evaluating a management team? Do you pay any attention to the gap the CEO gets paid compared to the second highest paid? Do you factor how much the employees get paid? I can't say I've actually looked a whole lot at what like average employees get paid typically when I'm assessing a management team. In terms of quantitative factors, they're reasonably straightforward. It's like how has return on equity and return on invested capital performed over time? Are they trending up or down, or are they stable? And also, what has their approach to debt been over time? And if they're repurchasing or issuing shares, I want to understand, do the prices make sense in terms of the buybacks? And if they are issuing shares, if any, I want to understand kind of why that's happening. So there's sort of the things that I tend to look at. It goes back to the whole Charlie Munger, show me the incentive and I'll show you the outcome kind of thing. You want ideally managers that are that have long-term incentive programs. There's plenty of managers that get stock-based compensation and so on, but often that can incentivize short-term performance if they've got expiry dates on options and they want the stock to shoot up in the short term or something. And if they only plan to be there 3 or 5 years and just want to make themselves rich without doing a whole lot for shareholders, that can be not the ideal approach if you plan to hold a stock for 5 or 10 years. So I think that's why people really like, founder-led businesses and that sort of thing, or people that just happen to have, a huge proportion of their net worth in a stock and have really no intention of selling. Those are some of the more maybe qualitative things that I tend to look for. Okay, next question is from Jeremy D. Which current investment managers have the best track records you know of in Australia, New Zealand, and internationally? Cheers. So there was some good data floating around on Twitter a couple of months ago. I'll try and find that tweet and the Twitter account and put that up on the screen here. They basically went through and collected a whole lot of the, I think, after fee returns from various fund managers. So most of these, if not all of them, are probably going to be US based, or at least they invest most of their portfolio in the US, but I'll put those up on the screen here. In terms of Australia and New Zealand, there's really very few, if any, that I follow. I came across a guy a few months back by the name of Mark Devcich. He runs various different funds here in New Zealand and Australia, and seems to have kind of a value-focused approach. And they put out, I think, quarterly statements, maybe even monthly statements on some of their holdings. And there are some very familiar names in there. We were seeing like Naspers, Alibaba, Facebook, Amazon, those types of stocks. So that's a useful one that I'm probably going to start looking more at, particularly with the Australian listed companies. I think I've got enough kind of clone-worthy individuals for the US, but that's one to check out. I'll try and track down the fund documents and pop those in the description below if you're interested as well. So thanks for your question. Next one is from MD. How do you find time to balance your full-time job and dedicating time to research companies while producing such great content? Well, I appreciate that, MD. So if you don't know already, I still work a 5-day-a-week, 40-hour-a-week job, and basically do YouTube in and around that. So my daily schedule, I guess, on days where I'm filming videos at least, is I basically just get out of bed an hour earlier, film a video, and then edit it, after work in the evenings. That's kind of the way I approach it. So that at least gives me filming and editing time. In terms of actually researching companies and trying to, understand investing concepts to actually make reasonable content, that can come in a few different forms. Maybe it's just listening to podcasts while I'm working, or, I have a 20-minute drive to and from work each day, and I'm pretty much listening to podcasts every kind of second I'm in the car. So that's very useful. And I've been a little bit slack on reading maybe the last couple of years at this point. And I think we got a question on reading shortly, so I'll bring up some books that I'm kind of working through at the moment. But, where possible, I try to dedicate, half an hour or something to reading each day if I can. Again, I've been a bit slack on that, but I'm usually pretty good on weekends and stuff. So that really gives me enough to, keep making reasonable content and keep pushing myself and trying to learn more as an investor. So hopefully that helps. I seem to be able to make it work, but I know people out there, have kids and have much more demanding jobs, and it's a little more challenging than my situation. But that's kind of the way I do it. So Thanks for your question. Next one is from the non-GAAP billionaire. Great username. Accounting question. If Prosus owns 30% of Tencent, does the ownership show up as any additional revenue for Prosus? If not, why? Do only subsidiaries that are 100% owned count towards revenue? Hence, since they own 30% of Tencent, none of the revenue flows through to Prosus. In some situations, it does. So I know, for example, I think the earnings of Kraft Heinz, I want to say, hit Berkshire's income statement. I may be wrong on that, but I'm pretty sure it has done in the past. And it's probably going to depend on the country a little bit. So I don't know the exact rules for, Naspers in South Africa, and Prosus, I think, is still a South African company, although they're listed in Amsterdam. Someone may be able to correct me on that. But there will be different accounting standards on these things, depending on the country that you're in. So there's certain thresholds in the US to where, it has to start hitting the income statements and the financial statements of the sort of parent company, and the smaller thresholds where it's just sort of part of the investment portfolio on the side. So I'd dig through some of the financials for Prosus, and you should hopefully be able to figure that out pretty quickly. Like Tencent is basically all of Prosus, so you should be able to figure out pretty quickly, like if Prosus revenue looks not even close to 30% of what the Tencent revenue is, then that means it's probably not flowing through the financial statements. But that's where I'd go to double check that. Next one is from Rack Pull Above the Knees. I like it. Do you think the real estate sector in China can cause contagion economic distress? Not an area of expertise for me, but I'm sure it could. I really don't have a whole lot to add on that. Unfortunately, we'll kind of just have to wait and see how that one plays out. Next one is from Larry. What do you think about Guy Spears' comment on traditional valuation metrics being obsolete in today's market? I think I think this one's kind of business to business dependent. Again, it's tough to kind of speak in absolutes and give broad statements that impact every single business in the stock market, or every single business in a particular country or whatever. So if you're analyzing a real estate business, clearly looking at the value of the assets is not an obsolete exercise. That's a very relevant exercise still in 2021. But if you're looking at a software business, for example, I think what Guy Spears is saying here starts to really make a lot of sense, where price to book clearly has basically no meaning for many software businesses. Ideally, the perfect business is kind of asset light and earns very high returns on equity and invested capital, and has a long runway to continue growing with not much capital investment. And if you're trying to value a company like that on a price to book basis, then that's kind of a waste of time. So I can certainly see where Guy Spears is coming from there. The other part of that is with sort of capital expenditure, whether it's maintenance versus growth versus just a cost of your standard operations. There's some interesting kind of ways that kind of flows through the accounts, and I think in certain situations, the earnings of software businesses can look more depressed than they maybe actually are, because there's some kind of what could potentially be called capital expenditure just flowing through the income statement and kind of pulling down earnings, and maybe some of those costs drop off over time and the business is actually a lot more profitable than the financial statements actually show. So there's some interesting kind of nuances there. But I think what Guy Spears is saying here particularly applies to software and technology type businesses. There's still always going to be businesses that have hard tangible assets, where more traditional approaches to valuing based off balance sheets and so on still makes a lot of sense. Next question is from Utter Love. Hi Tom, my question is, in what seems to be a euphoric market state, would you personally prefer to have a certain amount of cash reserve or remain fully invested, and why? Thank you kindly. So I've done a few videos over time on sort of cash, and I basically just cloned the Monash Probri approach to cash, which, if you're not familiar, it's basically, imagine you were just starting with a 100% cash portfolio. Forget about what the broad market's doing, just look at the micro, look at individual businesses. If I think I've got a handful of stocks to where I don't feel too concentrated, I've got kind of enough diversification but not diversified, I guess, across a huge number of businesses. If I think I can find enough opportunities where I think there's downside downside protection and it's maybe a double kind of return over the next 3 to 5 years, I'll invest about 75% of my cash into the market. And then there's various thresholds above that. So off the top of my head, I think the next 10%, so to get up to 85% allocated is a triple, and then you get up to 4x and 5x. So that last 5 or 10% of cash, there has to be something really, really attractive for me to want to deploy that. And I think that's just a nice way to do it. You're looking at the opportunity set of businesses that you understand and the risk reward profile on each of those, as opposed to focusing on kind of broad market valuations. There's that famous Peter Lynch quote that more money has been lost sort of waiting for a crash than has actually been lost in crashes. And, cash drag is a real thing. And that's a topic that we sometimes discuss on the Punch Card YouTube channel between myself and Frank Tabor and Karan Ganani. So it's an interesting topic. I try to detach myself as much as I can from broad market valuations and just look at the opportunities that I've kind of got available. Right, next question is from Brian Mendoza. Long opinion on Barber. Currently my top holding and plan on adding more. Any advice or light bulb ideas to think about? Thanks for the content. Yeah, I've spoken about Alibaba pretty extensively on this channel and also on the Punch Card channel. And I actually just recorded, I think, the first ever episode of Frank Tabor's new podcast. I think it's called Seeking Value, so that should be out in the next week or so. And we discussed Alibaba a little bit in depth there, but I really don't have a whole lot of new thoughts since the previous videos that I've made. Like, I thought the e-commerce business was worth north of maybe $250 a share or an ADR. You've got a fast-growing cloud business, and you've got the Ant Group stake kind of built in there as well. And then the two things that I really want to keep an eye on are kind of the VIE structure. Make sure nothing is going to kind of kill the investment from that aspect. And also looking at the pledges or donations that Alibaba kind of makes over time and making sure that that's not kind of getting out of hand. So that's kind of where I'm at. I really haven't been actually adding too much to that. I'm super comfortable with averaging down on stocks. I actually struggle more to average up, even if the story or the thesis with a particular investment is playing out. I just have this really annoying kind of price anchoring bias that I need to get rid of. So I really have no trouble averaging down on stocks, but also I don't want to get overexposed to any one particular stock like an Alibaba. At some point you just have to stop averaging down and be comfortable with being negative on a position, at least in the short term. So that's kind of where I'm at with Alibaba. Next one is from Aaron. How do you use enterprise value to revenue to find fair value of a stock? Personally, I'm looking at Peloton. Haven't really looked at Peloton, but I use enterprise value like all the time. I think it's very important to account for the cash and the debt that sits in a business and make sure that you're kind of capturing that when you do your valuations. So I use enterprise value all the time. I really almost never use sales or revenue multiples. I mean, unless you're doing a direct comparison with a business that is in like the same industry and does the exact same thing, I think they're not all that useful. Even in the same sector, sometimes you can have businesses that have very different margins. So, a lower margin business, obviously less of that revenue is going to drop out the bottom line and earnings and cash flows. So they deserve a lower sales multiple kind of as a result. So I don't use sales multiples a lot. I use multiples more generally from time to time, but they're really to give me an initial indication for whether I think it's just way out of my range and it's trading at 100 times earnings or something, and I'm probably just not going to be able to get there. I use that as an easy way to discard businesses, but I don't really invest because a multiple says a certain number. I'm typically doing either a discounted cash flow or looking at the balance sheet of the business and the assets that they own, if it's more of a maybe Seritage Growth Properties type tangible asset sort of play. So that's really the way that I think about it, but I appreciate your question. Next one is from Jeremy. With India set to surpass China's population in 2023 and become the world's third largest economy in 2026, potentially surpassing the US in the 2030s, what is your appetite for looking at Indian companies in 2022? I'd like to try and follow Brian Spear closely for their next purchase. Yeah, I've never invested in an Indian stock. I've been pretty open on the channel here that I would invest anywhere if the right opportunity kind of arose and I could get my head around it, which is probably the major caveat with going to another country like India. But yeah, again, sort of the way you've, I guess, laid out this question in terms of, the economy's growing very fast and they're going to be larger than the US and so on. They're not really the things that flow through my head. Certainly, they can be tailwinds for individual businesses, but I'm focusing on the individual business. So take an Indian Energy Exchange, for example, which has been one of the more successful investments in India from Monish Prabhu and Guy Spear, which you've both mentioned here. They really were focusing on the individual business, and certainly there's, a long runway for growth in terms of power usage in India. So that was sort of a broader tailwind as like a backdrop to analysing that individual company, but it's still very much analysing Indian Energy Exchange, the business, and figuring out how much cash that can throw off, as opposed to, demand for power is growing, so let's buy into any old power company, and that's kind of the extent of the analysis. That's not really the way they do it. They're still trying to focus on the cash that comes out, what price are we paying, and do we think that's a good deal? All right, next one is from Meow Chinchilla. How's powerlifting going? How do you stay injury free while being competitive? I haven't actually competed in powerlifting for, I think, probably 2 years or so now. I did a strongman competition in, I think, March of 2020. Planned to do one in 2021, but lots of cancellations and stuff with various lockdowns and so on. So haven't had a chance to compete, but still been training and getting back into it kind of out of lockdown recently. How do I stay injury free? Use good technique and, I guess, train frequently and train sub-maximally. If you are into powerlifting, you'll hopefully know what those things mean. Right, next one is from Maddie Donna 11. When and how did you first get started in value investing? I bought my first stock, and I think probably early 2017, I want to say. I discovered value investing relatively quickly after that, but didn't actually make an investment in like a value stock till really something like Thor Industries in late 2018. So it's probably a year and a half between starting investing and making my first investment in a stock that I thought was at a 50% margin of safety and so on. But I had sort of converted across to value investing mentally quite a few months before I made that investment. It was just I was disciplined enough to not just buy any old stock that looked kind of cheap. It was, being a harsh grader, I guess, as Monish Prabhu might say. What books are you reading currently? That's a question from Sten Hemming. So currently I'm working through, so I have a goal of reading 10 books for the year. I'm just about to finish book 9, so should be on track for that one before the year's out. But I'm currently reading this one, The Magic of Reality by Richard Dawkins. This is basically just like a how the world works kind of science book. Some of the chapters are like, these things like, what is a rainbow? Why do bad things happen? Is there life on other planets? And talking sort of through the science of each of those various things. So that's an interesting book. A lot of it is really a bit of a refresher on maybe high school science and a little bit of university science, but I enjoy that type of reading. Other stuff more on the investing front. So I'm currently, I just picked this up the other day. It's a book called Every Bastard Says No, and this is actually sort of a business book on the founders of 42 Below, which if any New Zealanders are watching, they might know that that's like a New Zealand vodka brand that business was sold a few years ago, and these guys ended up being some of the richer individuals in New Zealand as a result of that. So I will read that book shortly. I actually didn't realize at the time, but it's like it's a combination actually, which didn't realize, but it's a combination of like a business biography book / like a cocktail guide. So every few pages there's like a drinks break, which I don't know that I'll be participating in all of those, but that's another one I'm reading. And I've also got a couple of other ones here. So I've got this one's probably pretty well known, but The 7 Habits of Highly Effective People. I've never read it, but had this one recommended to me a few weeks ago, so that one's kind of on the to read list. And then a little while back I picked up a copy of The Snowball, Warren Buffett, which is a massive book, but I'll work through that hopefully maybe this summer once I've got through some of these initial other books that I'm working on at the moment. I will say that I think my reading's probably broadened a little bit more over the last kind of year or 18 months. For a good little while there, I was just kind of pounding away and reading all the, hardcore investing books. I was getting through Phil Town initially, then I think I read all 4 of his books, if you include the Phil and Danielle Town one. I was working through The Dundo Investor by Moshe Barai, Educational Value Investor by Guy Spear, and various other kind of soul investing books. I think I've broadened a little bit out now to just sort of general business and biography and how the world works type books, which is, a bit of a switch that I've made, but certainly still like the hardcore investing stuff as well. Okay, next question is from After Dinner Investor. Seritage extends half its debt, I think, and better communicates its list of properties, but the stock goes down. How big a deal is the $800 million debt thing, and what did you eat for dinner? Right, so we did a punch card investing stream all on Seritage yesterday, so more of the detail is in that. But if you don't know already, basically Seritage has a $1.6 billion loan from Berkshire Hathaway, all due in July 2023. They've extended that agreement to where half of that debt is still due in 2023, half is due in 2025, so that means they're probably going to have to find $800 million, which they don't just have lying around, to pay half that loan in 2023. They're probably going to have to find that from other types of financing, which I think is very good, because they're paying like a 7% interest rate on the loan at the moment from Berkshire, and that's probably going to drop to maybe 5%, 4% with more typical kind of real estate loans at the individual property level. So I think it's very significant, and you haven't had dinner yet because it's 9:30 a.m. as I'm filming this, but I'm probably going to have scrambled eggs for breakfast after filming this, so hopefully that answers that question. All right, let's take maybe one more question because we're about to run out of time here. But this one is from David. After looking at the Kolkata meeting with Guy Spear, I'm a bit obsessed with the hidden value and ways to identify it. Return on incremental invested capital is definitely an important one. How do you go about calculating it? So I think there's probably 2 sort of questions in there. So the hidden value one is interesting. I think when I spoke with Matt Peterson a couple of weeks on the podcast, he has been very good at finding these types of things. So sort of off financial statement value with kind of the software business and these long-term agreements through the Daily Journal Corporation with, very valuable real estate at Seritage, which is understated in the book value of the company. And also with a situation maybe like Naspers in South Africa, where you've got this big fat net asset value from the investment in Prosus, but the market price doesn't quite reflect that. So in terms of finding like hidden value, I think it's it's hidden, right? So it's not going to be easy to find on a screen and that sort of thing, and that's kind of the point. So for me, I've found those things from basically following other investors that I like and admire, and that's been a nice way of kind of having these things sort of get on my radar. And in terms of incremental invested capital, again, we actually touched on this on Punch Card yesterday, but basically Guy Spear doesn't care about the capital that's been invested up until the point where he invests in the business. He wants to look at retained earnings from when he makes an investment moving forward, what kind of cash is generated and what sort of returns on capital are generated from the the retained earnings, after he sort of invests. That's really what he's looking for there. Alright, so that is all the questions that we have time for today. If you did enjoy the video, please hit like and hit subscribe, and I will see you in the next one. Cheers.